Welcome to the podcast about investing in startups, where existing investors can learn how to get the best deal possible. And those that have never before invested in startups can learn the keys to success from the venture experts. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back for another edition of Investor Stories. On this special segment, the experts describe the most important lesson that they've learned and how that has changed the way they invest. This is the special segment called Lessons Learned. On today's special segment, we have Sheel Mohnot of 500 Startups. Sheel, what's one of the most important lessons you've learned through your experiences investing in and working with startups?
I think the most important lesson I've learned is that a strong founding team is super important. So, yeah, a strong founding team can make a product in a small niche apply way more broadly than a not great team in a fantastic market. And that not great team in a fantastic market might still be able to raise a bunch of money, but a super strong team with industry background will figure out a way to make it work. So that's sort of, I think, one thing I've learned.
Are there any ways at 500 that you can do quantitative analysis on some of the portcos, looking at things like founder market fit, domain expertise in the target market and things of that nature to sort of try and draw some correlations between success and some of these key factors?
Yeah, we can. We're starting to do so. We've got an internal team working on something called 500 Quant. It's hard because, although we've done over 1,500 investments, we don't necessarily have that data on all of them, but we're starting to collect that data. Where we do have interesting data is on all the companies is around, we get quarterly reports on all of them, so we know which sector they're in, at what stage they need to be to raise money, and that sort of thing. So we're starting to put that together. We hired some data scientists to our team recently to sort of analyze that data. But I do think that what you're talking about, we are very strategically positioned to have the best data because we've done the most investing. But unfortunately, we don't have a lot of that data at the moment. What we have is sort of trends that we've seen over time, having invested in a lot of companies individually, rather than an actual quantification of that data. But we're actually pretty excited to start working on quantification of that data right now.
On today's Investor Story segment, we have Guy Turner of Hyde Park Venture Partners. Guy, can you tell us a story highlighting a lesson that has changed the way you invest?
Yeah, I was lucky to make, this is going to sound weird, but I was lucky to make a pretty big mistake very early in my investing career. And so it allowed me to learn this insight early. And that is basically that as an investor, the relationships that are going to outlast everything else are the ones you have with other investors. So of course, we want really close relationships with our entrepreneurs, and we expect over time to, back several entrepreneurs, the best ones, multiple times, and hopefully we'll be lucky enough to have them pick us as well. But early on, we were investing in a company, and there was another firm in the deal, and the entrepreneur did not like the board member the investor who was sitting on their board from that firm. And they basically asked me, hey, if you guys are going to lead this deal, can you get the partner changed? And I said, oh, yeah, sure. Anything for my companies, naively, and kind of facilitated having a different partner from that firm joining the board. And this was extremely short-sighted. So in effect, regardless of what my personal feelings were about that partner, I completely slighted them. And they were a player in our ecosystem and looking at deals that we were looking at. And that was a big mistake. And about 2 months later, he cut me out of a deal which has turned out to be extremely successful. And that was a big learning lesson and, something that I think about a lot. And that is, above all, as an investor, as a venture investor, you have to be really, really careful about your co-investing relationships because they outlast portfolio companies. They last literally for decades.
Have you ever been blindsided by an action from a co-investor or another investor that you didn't see coming, that maybe you had no impact on the situation, or thought you hadn't done anything that could have caused somebody to cut you out or otherwise?
No, that was the only time, and I deserved it.
Gotcha. On today's special segment, we have Ben Narasin of NEA. Ben, can you tell us a story highlighting a lesson that's changed the way you invest?
There's been so many. Somebody said to me once, we were talking about a product that I had a lot of experience in, and I pointed out all the issues that they might experience that I certainly had. And they said, yeah, it's a good point. Sometimes you're better off buying the product than buying the company. And I can remember a time when I made an investment that was much more driven by ego. I think that when you let ego change your view, you get into a very dangerous place. I think when you get overconfident, that can be dangerous. And I guess the biggest of all, and this applies to both those comments, is when you talk yourself into something. I think when you talk yourself into or out of something, you are making a mistake in the vast majority of the cases. And how you can become sensitized to that. In many ways tied to sort of, you remember I mentioned earlier that there were times I knew I was making a mistake, but I made it anyway?
Yep.
I looked back on those because there are questions of what I would do differently now. The reason they were mistakes, I had figured out the investment was likely not to work out after I had verbally committed to making it. And this happened twice.
Yikes.
In both cases, I had said to the entrepreneur, I'm in. And my statement to entrepreneurs was always the same. Because, I'll get another lesson really quickly. I funded an entrepreneur once that was doing a rolling close. And I gave him the money. He was supposed to raise $1 million. He ended up raising $600,000. He then spent the rest of the year trying to raise the other $400,000, which totally diluted the time he got to spend on the business. And in the end, that business did not make it. And I realized, never do a rolling close. So in the future, because I was fortunate to learn that lesson relatively early, I said to people, look, here's the deal. I'm in for X. Let's call it $100,000 personally. But I'm in when the round is complete. So if you're raising $1 million, when you have 900,000, you have $1 million because I am in. You just tell me. In two instances, one was particularly severe. One took 6 months. It came back to me when the round was done. It was clear to me it wasn't going to work. And I wrote a check, shook their hand, and handed them the money. Because I had made a commitment.
Sure.
And I was going to live up to it. But in one case, when it was 6 months after the fact, things had changed materially. So it is who I am. It's the way I think about the world. If you can't honor your word, what are you good for? It really, truly is. Your word is your bond. Your reputation, your brand is all you have. But I do think about that one where 6 months later, the business has had a material change. What does that look like? How do you avoid that? Now, I guess the advantage I have is, as a venture investor, I'm not in a situation where I'm waiting for other people. I'm making a decision. And I do think your word is your bond and you have to honor it. In 10 years of doing this, I have only seen a VC renege on a term sheet once. A VC that I respect as a firm. I won't use those words about this human being. And I will not ever go anywhere near that VC. And I will do what I need to do to make sure my entrepreneurs stay away from them as well, this particular individual. Not because just did they walk away from the deal, but because I think a lot of the reason they walked away from it was self-inflicted by the VC. Anyway, it's such a rare thing. I have seen on 2 instances before I started doing venture, entrepreneurs walk away from a VC's term sheet because the VC was trying to, what I would term, quote unquote, betrayed the deal. And that, I think, is also inappropriate. The deal it's an unfortunate trait in private equity, apparently, where sometimes when there's multiple buyers trying to buy a product, they'll bid higher, but then miraculously find reasons to pay less in the diligence. A very, very sleazy trait as far as I can tell. So, I think you've got to make your decision. You've got to put something out there that you can honor, and you got to stay with it. So, I think what I did learn, you don't do rolling closes. I did learn it doesn't, you got to make sure there's capital is a de-risking element. And it took me a while to really understand that. People would say, well, you got to make sure you put in enough money to de-risk the business. And I thought, dude, these businesses are absolute risk. How can that possibly impact it? They either have money or they don't. But what I realized is it's enough capital to get to a certain point.
Right.
Now you have to, like when you're doing seed investing, a seed round until recently wasn't meant to build a company. It was meant to allow you to prove or disprove a thesis. So you put that $1 million in, that entrepreneur either gets to or doesn't get to a thesis proof that allows them to raise a Series A, and the Series A allows them to build a company. So it's the mitigation of risk is providing enough capital to get to the next chapter and then being able to raise money off of that chapter to get to the chapter after that. Because I've certainly learned a long time ago and very much believe every round is about the next round. Every round is giving you the fuel to get to the next stage. And you've got to understand whether you have enough to get there. And I've seen investors far more experienced than I make this mistake. I've seen it twice where they would, in one of my prior funds I was involved with, they wanted to fund a business, but what they weren't seeing was the money they gave them wouldn't get the entrepreneur to the end point and the dream that they thought they were funding. It would only get them a quarter of the way there. And then they'd have to raise money again. And yet they wouldn't have achieved enough to raise that money. So it was like, okay, great. As long as you can fund them 4 times, you're good to go. Anyway, lots and lots. There's so much. I mean, this is a never ending. It's like anything you dedicate your life to. You're always learning. Or one would hope that people remain plastic enough that they have the brain elasticity to always be learning. Because if you're not, I think you're going the other direction.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.